Right now, as you're looking at your screen, you see silver quoted at $79 or $80 per ounce. That's the official price Wall Street wants you to believe in. The price they print on your trading apps. The price CNBC scrolls across your television. The price that shows up when you Google silver price today. But at the exact same moment, a solar panel factory owner in China is paying exactly $91 per ounce to keep his production line running. And this isn't some anomaly or temporary glitch. This is happening right now, today, as I speak to you. This $11 or $12 chasm isn't a simple market fluctuation that will correct itself by next Tuesday. This is official proof that the global arbitrage mechanism has collapsed and that paper promises have completely decoupled from physical reality. And I'm going to prove to you with receipts, with documentation, with mathematical certainty why you cannot buy silver in New York and sell it in Shanghai for a profit today, and why this situation points directly to what I call the stage 4 collapse of the financial system. Mathematics doesn't lie, but people do. And the mainstream media is lying to you right now about what's actually happening in the silver market because they need you to remain calm. They need you to keep believing in the legitimacy of paper contracts. They need you to think everything is functioning normally when the reality is that we are watching a bifurcation, a splitting of the global commodity markets into two completely separate pricing universes. Let me walk you through the 4-stage economic pattern that repeats throughout history with mathematical precision. Because what's happening in silver right now is not stage 1, it's not stage 2, it's not even stage 3. We are deep into stage 4. And if you understand this framework, you'll understand why the $12 spread between New York and Shanghai is not a trading opportunity, but a warning siren. Stage 1 is economic expansion, where debt grows, but productivity grows faster, where everyone feels wealthy, where governments can borrow and businesses can expand, and individuals can take out mortgages, and everything seems to work. Think of America in the 1950s and 60s, or China in the 1990s and 2000s. Stage 2 is when debt continues to grow, but productivity growth slows, where you start needing more and more credit to generate the same amount of economic activity, where central banks begin their first experiments with unconventional monetary policy, where the warning signs appear, but everyone ignores them because things still feel relatively normal. This was the United States from roughly 2000 to 2008. Stage 3 is crisis and response, where the debt bubble bursts, where Bear Stearns collapses, where Lehman Brothers fails, where governments respond with massive bailouts and money printing and zero interest rates and quantitative easing, where they patch the system together with duct tape and prayers and tell you everything is fixed. This was 2008 to 2020 for most Western economies. And stage 4, where we are right now, is systemic breakdown, where the tools that worked in stage 3 no longer function, where printing money no longer stimulates the economy, but instead creates inflation, where interest rates can't be raised without causing government insolvency, but can't be kept low without destroying currency value, where the contradictions become so severe that markets begin to fracture and bifurcate and stop functioning as unified global systems. This is not a prediction. This is a historical certainty because this exact pattern has played out in Rome when they debased their currency in Weimar Germany, when they printed to pay war reparations in Zimbabwe, when they destroyed their agricultural base in Venezuela, when they relied on oil revenues and printed to cover deficits. And now it's playing out in the United States and the broader Western financial system. And the silver market is the canary in the coal mine, showing you exactly where we are in this cycle. Now let me explain why that $12 spread exists and why it cannot be arbitraged away, because this is where the mathematical proof becomes undeniable. In a functioning market, if silver is $79 in New York and $91 in Shanghai, an arbitrageur would immediately buy silver contracts, or physical silver in New York, ship it to Shanghai, sell it for $91 and pocket the $12 difference minus shipping and transaction costs. This is arbitrage 101. This is what keeps global markets connected and prices aligned across different exchanges in different countries. But here's the problem. You can't actually do this right now, and I'm going to tell you exactly why with specific, concrete reasons that expose the entire illusion. First, when you buy silver on the COMEX in New York, you're not buying silver, you're buying a paper contract that promises you silver, and the COMEX operates on a fractional reserve system where they have perhaps 100 to 200 paper claims for every single physical ounce in their vaults, which means when you try to take delivery, you enter a queue, you face delays, you encounter delivery problems, you get offered cash settlement instead, and if too many people try to take physical delivery at once, the entire system would collapse because the silver simply isn't there. Second, even if you manage to get physical silver out of COMEX, and let me be clear, some people do succeed, but it's becoming increasingly difficult and expensive. You then face export restrictions, documentation requirements, and the reality that the United States government can and will block precious metals exports if they deem it necessary for national security, which is exactly what happened with other strategic commodities in recent years, and exactly what they'll do with silver if the shortage becomes acute enough. Third, shipping physical silver internationally has become extraordinarily expensive and logistically complex, with insurance costs skyrocketing, with shipping container availability fluctuating wildly, with ports experiencing delays, and with the actual transit time, meaning you're taking price risk for weeks or months while your capital is locked up in metal sitting on a container ship. Fourth, when you try to sell that silver in Shanghai, you're entering a market with its own rules, its own documentation requirements, its own import duties and taxes, and its own regulatory framework that can change overnight if the Chinese government decides it needs to conserve silver for domestic industrial use, particularly for solar panels, which China is manufacturing at absolutely staggering scale, using over 185 million ounces of silver annually just for photovoltaic applications, which is more than 20% of total global silver mine production. And fifth, this is the crucial point that nobody in mainstream media wants to discuss. The Chinese buyer at $91 per ounce is not stupid. He's not overpaying out of ignorance or inefficiency. He's paying $91 because that's what he has to pay to actually get physical silver delivered to his factory floor in the quantity and time frame he needs. Because the global physical silver market has essentially separated from the paper silver market. And the paper market price of $79 is increasingly irrelevant to anyone who needs actual metal for actual industrial production. This bifurcation, this splitting into two separate markets, is exactly what happened in the 1970s with gold, when the London gold pool collapsed, when central banks could no longer suppress the gold price through coordinated selling, when the official price and the free market price diverged so dramatically that the entire Bretton Woods system fell apart. And what you're seeing now in silver is the same dynamic playing out in real time. The Shanghai price is telling you what silver is actually worth when you need physical metal. The New York price is telling you what financial institutions are willing to pay for paper contracts. They have no intention of converting to physical delivery. Now, let's talk about why this matters to you personally. Because I'm not giving you this information as an academic exercise or as entertainment. This has direct implications for your financial survival in the next 24 to 36 months. If you own paper silver contracts, ETFs like SLV or futures contracts or certificates of any kind, you need to understand that you do not own silver. You own a promise to receive silver, and that promise is becoming increasingly questionable as the gap between paper and physical markets widens. Because when the system experiences enough stress, those paper contracts will be cash settled at whatever price benefits the issuing institution, not you. Or they'll cite force majeure, or they'll change the rules exactly as they did when they changed margin requirements during the GameStop situation, exactly as they did when they suspended trading in various markets during the 2008 crisis, exactly as they always do when the wealthy and powerful are about to lose money. If you're planning to buy silver as a hedge against inflation or currency debasement, you need to buy physical metal, coins or bars that you can hold, that are in your possession or in a vault you directly control, not a bank's vault, not a broker's vault, not some pooled account where you own a share of unallocated metal. Because the entire point of owning precious metals is to have an asset that exists outside the financial system, that can't be printed or inflated or defaulted on, but that only works if you actually have physical possession. And if you're thinking, I'll just wait until the price drops before I buy, you need to understand that the bifurcation I'm describing means there might not be any physical silver available at the paper price you're watching. You're looking at 79 on your screen, but when you actually try to buy significant quantities of physical silver, you're discovering premiums of 20%, 30%, 40% over spot price, which means you are actually paying prices much closer to that Shanghai physical price than the New York paper price. And those premiums are not going down, they're going up, because the supply is genuinely constrained and demand is accelerating. Let me give you the supply-demand fundamentals that explain why this bifurcation is happening now and why it's going to get much worse. Global silver mine production is approximately 830 million ounces per year. And that number has been essentially flat for the last 5 years, despite the price increasing. Because silver is primarily a byproduct of other mining operations, about 70% of silver comes as a secondary product from mining copper, lead, zinc, and gold, which means silver production doesn't respond to price signals the way a primary product would. Because miners aren't opening new silver mines when the price goes up. They're opening copper mines or gold mines that happen to produce some silver as a side benefit. Meanwhile, demand is exploding across multiple sectors simultaneously. Solar panels are using 185 million ounces and growing at 15-20% annually as both China and the West mandate renewable energy transitions. Electronics and 5G infrastructure require silver for circuitry and conductivity. Electric vehicles use significantly more silver than internal combustion vehicles. Industrial applications, from medical equipment to water purification, need silver for its unique properties. And investment demand is surging as people wake up to the currency debasement and inflation that's destroying their purchasing power. When you add up all these demand sources, you get approximately 1.1 billion ounces of annual silver demand against 830 million ounces of annual mine production, which creates a structural deficit of roughly 270 million ounces per year. And that deficit is being filled by above-ground inventories' existing stockpiles that are being drawn down month after month, year after year. And those stockpiles are not infinite. The Silver Institute estimates total above-ground silver stockpiles at around 2.5 billion ounces, but much of that is in jewelry, silverware, and other forms that aren't easily mobilized into industrial supply. And the amount in exchange-visible inventories, COMEX, LBMA, ETFs, has been declining dramatically, with COMEX registered silver falling to levels not seen in years, despite the price increasing, which is exactly the opposite of what should happen in a normal market where higher prices bring out more supply. This is the same pattern we saw before every major commodity squeeze in history. Supply declining, demand increasing, inventories falling, and price disconnection between paper markets and physical markets widening until something breaks catastrophically. And here's what makes the current situation unprecedented. In previous commodity squeezes, the shortage was typically in one sector or one geographic region. But what's happening with silver right now is a global multi-sector shortage where industrial users, investors, and governments are all competing for the same shrinking pool of physical metal. And the paper market manipulation that has suppressed silver prices for decades is losing its effectiveness because you cannot print physical silver, you cannot create it with a keyboard, you cannot bail it out with quantitative easing. It either exists in physical form or it doesn't. And increasingly, it doesn't exist in the quantities needed at the prices being quoted. Now, let's connect this to the broader economic stage 4 collapse I mentioned earlier. Because silver is not bifurcating in isolation, it's bifurcating because the entire global financial system is fracturing under the weight of unsustainable debt currency debasement and the loss of trust between economic actors and nations. The United States has $36 trillion in official federal debt. But when you include unfunded liabilities like Social Security and Medicare, the real number is over $200 trillion. That is debt of approximately $600,000 per citizen or $1.5 million per taxpayer. And there's no mathematical way to pay this back through taxation or economic growth. The only options are default, which would collapse the financial system, or inflation, which means printing money to pay obligations in currency that's worth less and less, which is exactly what's happening right now, despite what the official CPI numbers claim. And it's not just the United States. Japan has debt to GDP over 260%. European nations are drowning in sovereign debt. China has a property bubble that makes the 2008 US housing crisis look small by comparison. And emerging markets are caught between dollar-denominated debts and weakening local currencies. When you're in stage 4 of the economic cycle, where the debt cannot be serviced without destroying the currency, but the currency cannot be preserved without defaulting on the debt. Governments and central banks become increasingly desperate and erratic. They impose capital controls, they manipulate markets more blatantly, they change rules retroactively, they prioritize connected insiders over ordinary citizens, and they allow or even encourage market bifurcations where different participants face completely different prices for the same assets. The Paohua spread between New York paper silver and Shanghai physical silver is a symptom of this systemic breakdown, a visible crack in the facade of the unified global market system that has existed since the end of World War II. And that crack is going to widen into a chasm because the underlying contradictions cannot be resolved. They can only be papered over temporarily until the next crisis, which comes faster and hits harder than the previous one. I want you to think about what this means practically in your life over the next 12 to 36 months, because we're not talking about abstract economic theory. We're talking about your ability to preserve the value of your work, your savings, your retirement, your family's financial security. When markets bifurcate, when paper prices and physical prices separate dramatically, the people who get hurt are always the ordinary citizens, who believed the official numbers, who trusted the system, who kept their savings in paper assets that evaporated when the music stopped. This happened to middle-class Germans in Weimar, to middle-class Argentinians in their multiple currency crises, to middle-class Venezuelans who watched their savings become worthless. And it's happening right now to middle-class Americans and Europeans who don't yet realize their currency is being systematically devalued to service unsustainable debts. The people who survive these transitions are the ones who recognize the pattern early, who move their wealth out of paper and into tangible assets before the bifurcation becomes obvious to everyone, who understand that the official price quoted on financial networks is increasingly irrelevant compared to what you actually have to pay to acquire physical goods in the real economy. This is why the silver bifurcation matters. It's not just about one commodity. It's a leading indicator of a broader market structure breakdown where the financialized paper economy and the real physical economy are divorcing from each other. And you need to decide which economy you want your wealth denominated in. The paper economy of promises and digital entries that can be inflated, defaulted on, or confiscated, or the physical economy of real assets that maintain their utility regardless of what happens to currencies and financial systems. Now let me address the question I know you're asking. If this is so obvious, why isn't everyone talking about it? Why isn't it on CNBC? Why aren't financial advisors warning their clients? The answer is both simple and disturbing. The mainstream financial media exists to maintain confidence in the system, not to tell you the truth, because the entire modern economy runs on confidence. Confidence that your bank deposits are safe, that your government bonds will be repaid, that your currency will hold its value, that markets are fair and transparent. And the moment that confidence breaks, the moment people rush to convert paper into physical assets en masse, the system collapses immediately. This is why you will never hear a major network discuss the COMEX silver inventory problems. Honestly, why you'll never see a financial advisor recommend putting 30% of your portfolio into physical precious metals. Why government officials will continue to assure you that inflation is transitory and under control, even as grocery prices double. Because they need you to keep believing, to keep working, to keep saving in their system, to keep your wealth where they can access it, control it, and ultimately devalue it to pay for their unsustainable promises. The people who benefit from the current system, the major banks who trade silver contracts with leverage, the governments who need low interest rates to service their debts, the financial media who earn advertising revenue from those same banks, all have a vested interest in maintaining the illusion that paper and physical are the same thing. That the $79 COMEX price is the price of silver, that markets are functioning normally, and they will maintain this illusion until the very day it becomes impossible to maintain, at which point they'll claim nobody could have seen it coming, exactly as they did in 2008, exactly as they always do. But you can see it coming because you're watching the evidence right now. A $12 spread between paper and physical that cannot be arbitraged. COMEX inventory declining while demand surges. Industrial users paying massive premiums over spot price delivery delays extending from weeks to months, and the mathematical impossibility of satisfying all the paper claims with available physical metal. This is not conspiracy theory. This is documented fact that you can verify yourself by calling dealers, by checking exchange data, by talking to industrial users, by looking at import and export statistics. The question is not whether the bifurcation is happening. The question is what you're going to do about it before the bifurcation becomes common knowledge, and physical silver becomes unavailable at any price that is recognizable by today's standards. Let me give you some additional context about how this pattern has played out historically, because understanding the past is the only way to prepare for what's coming. In the late Roman Empire, they faced the exact same problem we're facing today. Excessive military spending, declining tax revenues, loss of productive capacity, and a government that needed to pay its obligations, but didn't have the resources to do so honestly. Their solution was to debase the currency. The denarius went from nearly pure silver to less than 5% silver content over a period of about 200 years, and what happened was predictable. People stopped accepting the official coins at face value. They demanded more and more coins for the same goods and services. The economy bifurcated into an official economy where government edicts set prices, and a black market economy where real supply and demand determined prices, and eventually the entire Western Roman Empire collapsed under the weight of its own monetary fraud. In Weimar Germany after World War I, the government faced war reparations they couldn't pay, so they printed marks to make the payments, which caused inflation, which required more printing, which caused more inflation and a death spiral that ended with people using wheelbarrows full of cash to buy bread, and with the complete destruction of the German middle class as savings. The official exchange rate said one thing, but the street price for goods said something completely different. That's bifurcation. That's what happens when paper loses credibility faster than the government can print it. In Zimbabwe, in the 2000s, Robert Mugabe's government seized productive farmland. Agricultural output collapsed, tax revenues disappeared, but government spending continued, so they printed Zimbabwe dollars, which created hyperinflation that eventually reached 89.7 sextillion% annually. You read that correctly? Sextillion with 21 zeros. And the currency became so worthless that they eventually abandoned it entirely and switched to using US dollars and South African rand. The official price and the street price diverged so dramatically that the official price became a joke, a fantasy, completely disconnected from reality. And in Venezuela, more recently, we've watched the exact same pattern. A government dependent on oil revenues, oil prices collapse. Government spending doesn't adjust. They print bolivars to cover the gap. Hyperinflation destroys the currency. People flee to dollars or crypto or barter. and the official exchange rate becomes a fiction that nobody believes. In every single one of these cases, the people who preserved their wealth were the ones who converted paper into tangible assets early before the bifurcation became obvious to everyone. And the people who lost everything were the ones who believed the government, who trusted the official numbers, who thought it can't happen here, who waited too long to act. And here's what I need you to understand. The United States and the broader Western financial system are not immune to these historical patterns, just because we have computers and sophisticated central banks and reserve currency status. In fact, those things make the eventual collapse worse because they allow us to accumulate more debt, to postpone the reckoning longer, to build up greater imbalances that create a more violent correction when reality finally reasserts itself. The taller 12 spread between New York and Shanghai silver prices is telling you that reality is reasserting itself right now, that the paper illusion is cracking, that the bifurcation is beginning, and that you have a choice to make about which side of that bifurcation you want your wealth positioned on. Here's your action plan, laid out in concrete steps that you can implement starting today, because information without action is useless. And I'm not here to entertain you. I'm here to help you survive what's coming. Step 1, assess your current portfolio and calculate what percentage is in paper assets versus physical assets. This includes your bank accounts, your stocks, your bonds, your retirement accounts, everything that exists as a digital entry in a financial system, versus things you can touch and hold, and be honest with yourself about the risk you're taking by having the majority of your wealth in paper form. Step 2, determine your risk tolerance and timeline, because if you're 70 years old on a fixed income, your strategy will be different than if you're 35 with a stable job and decades until retirement. But regardless of your situation, you need some physical assets outside the financial system as insurance against systemic failure. Because insurance is what you buy before you need it, not after the disaster has already occurred. Step 3, start converting a portion of your paper wealth into physical silver, and I specify silver rather than gold, because silver has more upside potential due to its industrial applications, and because it is more accessible for average investors. You can buy silver coins in small denominations, starting at $30 to $40 per ounce, including premiums, whereas gold is over $2,700 per ounce, making it harder to accumulate and harder to use in smaller transactions if the currency system breaks down. Step 4, buy from reputable dealers and take physical possession. Do not buy paper silver ETFs or certificates, thinking you'll convert them to physical later, because later might be too late. Pay the premium, wait for delivery, and store the metal somewhere you control, whether that's a home safe, a private vault, or a secure storage facility that's fully allocated and segregated in your name. And make sure you have documentation proving ownership. Step 5, continue to dollar cost average into physical silver over time, buying consistently regardless of short-term price fluctuations, because the point is not to trade silver for profit, but to accumulate real assets as insurance against the stage 4 collapse that's accelerating around you. And dollar cost averaging smooths out the volatility and removes the emotion from the buying decision. Step 6, diversify your tangible asset base beyond just silver. Consider gold as well for larger and wealth preservation. Consider other hard assets like productive land or essential commodities. Consider skills and knowledge that will remain valuable regardless of what happens to financial markets. Because resilience comes from multiple layers of preparation, not from putting everything into one asset class. And step 7, stay informed by following the actual data rather than mainstream financial media. Watch COMEX inventory numbers, monitor the spread between paper and physical prices, track industrial demand trends, pay attention to what's happening in the physical market rather than what talking heads on television are saying about the paper market. Because the bifurcation I've described today is going to widen, and the people who see it early will have opportunities that disappear once everyone else figures it out. Let me also address some common objections and questions that I know you're thinking right now. Because if I don't address them, you'll use them as excuses to postpone action. And postponing action in stage 4 of an economic collapse is the most expensive mistake you can make. Objection 1, but silver doesn't pay dividends or interest, so I'm losing opportunity cost by holding it instead of stocks or bonds. My response, stocks and bonds are paper claims on future cash flows denominated in a currency that's being systematically debased. So the nominal returns you're earning are being eaten away by real inflation that's much higher than the official CPI suggests. And when the bifurcation completes and the paper market collapses, your stocks and bonds will be worth dramatically less in real purchasing power terms, whereas physical silver will maintain its utility and value because it has intrinsic properties that make it useful for industrial applications, regardless of what happens to fiat currencies. Objection 2, well, but the government could confiscate gold and silver like they did in 1933. My response, yes, FDR's Executive Order 6102 required U.S. citizens to turn in gold coins and bullion in exchange for paper dollars at a fixed price. But that was a different era with different technology and different social conditions. And even then, compliance was partial at best, with significant amounts of gold remaining in private hands. And more importantly, the alternative of holding only paper assets in a stage 4 collapse guarantees loss through inflation or default. Whereas holding physical metals gives you at least a fighting chance to preserve wealth, even if some confiscation risk exists. Objection 3. But I can't afford to buy much silver, so what's the point? My response? Every ounce you own is 1 ounce more than you would have had if you did nothing, and when the bifurcation completes and physical silver becomes unavailable or unaffordable in terms of your debased currency, you'll be grateful for every single ounce you accumulated while it was still possible, because the difference between having some tangible assets and having none could be the difference between maintaining some standard of living and losing everything. Objection 4. But what if the price drops after I buy? My response: you're not buying silver to trade it for short-term profits. You're buying it as insurance against systemic collapse, and you don't cancel your homeowner's insurance just because your house didn't burn down last year. You maintain it as protection against a low probability but high impact event. And the stage 4 economic collapse is no longer low probability. It's increasingly certain, and the only question is timing. And objection 5. But this sounds too extreme, too apocalyptic. Surely things can't be that bad. My response: I've given you the data, I've shown you the historical patterns, I've documented the $12 spread that proves the bifurcation is happening right now, and you can choose to dismiss this as extremism and continue believing the mainstream narrative that everything is fine. Or you can look at the mathematical impossibility of servicing $200 trillion in unfunded liabilities and realize that something has to give, and when it gives, it's going to give suddenly and violently, and the people who prepared will survive, while the people who trusted the system will be destroyed. This is not a prediction. This is a historical certainty based on every previous example of unsustainable debt and currency debasement throughout human history, and the United States is not special or exempt from these economic laws just because we've been the dominant power for the last 80 years. Now, let me tie this all together with a final thought about what the silver bifurcation really means and why it matters so urgently. The $12 spread between New York and Shanghai is not just about silver. It's a symptom of a dying global financial order, of the post-World War II Bretton Woods system, and its successor, the petrodollar system, finally collapsing under the weight of accumulated contradictions and unpayable debts. When the global reserve currency is being debased through money printing, when the country that issues that currency has become the world's largest debtor instead of the world's largest creditor, when trust between nations is breaking down, and they're increasingly settling trade in currencies other than dollars, when capital controls are being implemented and financial markets are fragmenting into regional blocks, you get bifurcation, you get different prices for the same assets in different markets because the arbitrage mechanisms that connected those markets are breaking down. This happened when the British pound lost reserve currency status in the first half of the 20th century. It happened when the Spanish real and the Dutch guilder lost their dominant positions in earlier eras, and it's happening now with the US dollar. And silver is simply the most obvious place to see it, because silver is both a monetary metal with thousands of years of history as money and an industrial commodity with critical applications in the modern economy, which makes it uniquely positioned at the intersection of the old monetary system and the new technological economy. The bifurcation in silver prices is telling you that the old system is dying and the new system is being born, and the transition between systems is always chaotic, always destructive of paper wealth, always advantageous to those who position themselves in tangible assets before the transition becomes obvious to everyone. You are living through a historic transition right now today, whether you recognize it or not. And the decisions you make in the next 6 to 12 months about how to position your wealth will determine your financial outcome for the next 20 to 30 years. This is not hyperbole. This is simply the reality of living through a stage 4 economic collapse and monetary system transition. And the silver market bifurcation is your early warning signal, your chance to act before the crowd realizes what's happening and the physical metal becomes unavailable at any price. The mathematics of the situation are inexorable. 830 million ounces of annual mine production against 1.1 billion ounces of annual demand equals a 270 million ounce deficit that's draining the above ground stockpiles, and when those stockpiles are exhausted, the paper market will collapse because you cannot deliver what doesn't exist. And the price will have to rise to whatever level is necessary to destroy enough demand to bring the market back into balance, which could be $150 per ounce, could be $200 per ounce, could be $500 per ounce. Nobody knows the exact number, but we know the direction is up, dramatically up, because the laws of supply and demand cannot be repealed by central bank policy or government decree. And when that happens, when the paper market breaks and the price explodes, the $91 that Shanghai buyers are paying today will look like an absolute bargain. And the $79 New York paper price will be remembered as the final illusion before reality reasserted itself. And the people who accumulated physical silver at $30, $40, $50 per ounce will look like geniuses, not because they were smarter than everyone else, but because they recognized the historical pattern and acted on it before the crowd did. This is your moment. This is your opportunity. This is your warning. The silver market has bifurcated. The stage 4 collapse is accelerating the mathematical certainty of unpayable debts, and unlimited money printing is playing out exactly as it has in every previous empire that tried this same failed experiment. And you can either position yourself in tangible assets that will preserve value through the transition, or you can remain in paper assets that will be destroyed when the bifurcation completes and the currency reset occurs. The choice is yours. The time is now, and the consequences of inaction are irreversible, because once physical silver becomes unavailable at affordable prices, once the bifurcation is obvious to everyone, once the crowd realizes what's happening and rushes to convert paper to physical, it will be too late. The window will have closed and you'll be stuck with the paper promises that won't be honored and the currency that won't hold its value. Don't let that happen to you. Act now, start small if you must, but act, because every day you wait is a day closer to the moment when the system breaks, and your opportunity to protect yourself disappears forever.